In this video, I'm going to prepare a flexible budget performance report. And it's going to be a very similar example to one of your Set A problems. And it's going to demonstrate the whole entire report, including the flexible budget, planning or static budget, and the different variances. The setup up above is for revenues and different expenses, from technician wages to miscellaneous expenses. They're examples of expenses. We have both our actual costs and revenue here all the way to the right for February. And also we have formulas to help us predict our revenue and cost at different activity levels. They tell us we measure activity by the number of jobs, and they also tell us that while we predicted that we were going to work 120 jobs in February, the actual number of jobs worked is 128. So let's go ahead and clear some space for a flexible budget performance report because it's going to need quite a bit of space, but I'll go ahead and list our actual and formulas here up above. So I'm going to start out our flexible budget performance report all the way here to the right with our actual information. And I just gathered that from the problem. It told us we actually worked 128 jobs, and it gave us all the actual revenues and expenses here listed in red. So I just listed those, for example, actual revenue of $30,250. All I did is sort it out a little bit is I went ahead and subtotaled all our expenses, again from technician wages of $82.50 to miscellaneous expenses of $365, giving us a total expense of $23,775. Subtract that from our total revenue of $30,250, and we get an actual net operating income of $6,475. At this point, you might be asking, how's this different than a basic income statement? Wait, we're moving on to our next steps. Our next step is we're going to calculate the flexible budget. And how I'm going to do that is I'm going to use the formulas up above, but I'm going to flex that for the actual amount of activity, which is 128 jobs. So for jobs in the flexible budget, we use actual, which is 128. These are all different numbers. And for example, how did I calculate revenue? Well, I just took the formula up above where it said that the revenue or sales price per unit is $275, and I'm going to flex that or multiply it times the actual number of jobs worked of 128, and that gives me actual revenue of $35,200. You may notice that technician wages of $8,400 agrees with the fixed component per month listed up above of $8,400. Fixed means I don't anticipate that it's going to change based on the activity level, so I can just list it down here. But on the other hand, mobile lab operating expenses has both a fixed component of $4,600 plus a variable component of $30 per job. So I am going to have to flex this. For example, I'm going to take that $4,600 fixed portion plus $30 variable portion times the actual number of jobs, 128, and get a flex mobile lab operating expense of $8,440. So I calculate the items similar, add up all my expenses, $25,132, subtract it from my flex revenues of $35,200, and I get a flex not operating income of $10,068. Again, what does that mean is I would have anticipated earning income of $10,068 based upon 128 jobs. That's what I would have anticipated if all my formulas I actually came true. So let's go ahead and take a look at what variance would this calculate if I compare actual results to flexible budget results. Well, it would be called a revenue variance if we're comparing actual revenue to flexible budget variance. And it would be called a spending variance if we're comparing an actual expense to a flexible budget expense. So same comparison, just different terminology depending on if we're talking about revenue or expense. So let's go ahead and look at our revenue, actual $30,250 minus our flexible budget revenue of $35,200. If you subtract those, it is $4,950. But where does this unfavorable come from? Step back and think about it. If our actual revenue is less than what we thought it was going to be based upon the actual activity level of 128, that's bad, right? It's definitely not good. That's going to be unfavorable. What might have caused this? Well, the answer isn't that we sold less jobs. that's not correct because we base both of these numbers on selling 128 jobs. The answer may perhaps be if we have different types of jobs. Maybe we anticipated selling more expensive ones and we actually sold cheaper ones. So it might actually be the mix of what we sold, not the quantity of what we sold. So let's go ahead and go down and calculate our spending variances. For example, I did that for technician wages, mobile lab operating expenses, and office expenses. And you notice all of those listed were favorable. So let's give you an example. Technician wages, actual is $8,250. I compared that to the flexible budget of $8,400, and it's favorable. It's a $150 difference, but it's listed as favorable. Well, how is that true? Because it's a good thing when we have less expenses compared to our flexible budget. That's actually a good thing, so that would be favorable. So keep in mind the rules flip around here. When revenue was less than what we thought it should be, it was bad. But on the other hand, when expenses are less than what we thought they were going to be, it's a good thing, so it's going to be favorable. What might have caused these different favorable variances here? Again, it doesn't have anything to do with selling less jobs you anticipated. It might be the quantity, not the number of jobs, but for example, technician wages. It might be that those employees actually spent less time on those jobs that we anticipated because maybe we trained it better, they were just better skilled. On the other hand, it might be because we used cheaper wages. For example, we might not have given the pay bump that we anticipated giving them, or again, used less skilled people who ended up being cheaper. Let's take a look at advertising expense. Actual advertising expense of $1,630 compared to our flexible budget of $1,560. That's a $70 difference, but you'll notice I listed that as unfavorable because of the fact if actual expenses are greater than what we thought they should be, that's not a good thing. Again, what could have caused that? Doesn't have anything to do with more or less jobs, but it could perhaps been the amount of advertising that we use. So maybe we put more social media ads out there than we anticipated, or it might have been the cost of the ads that we use. Maybe there were more costly ads than we anticipated. Now I'm going to go ahead and just finish this off. For example, insurance. We had $2,880 cost. We anticipated it's going to be $2,880, so there's no variance at all. If we finish this off and add up and compare our total expenses of $23,775 actual to our flexible budget expenses of $25,132, because actual is less than flexible, we have a $1,357 favorable total expense variance. Net operating income flips around though, because keep in mind our actual net operating income was $6,475 compared to what we thought it should have been of $10,068. Net operating income should be a good thing, and if it's less, that's a bad thing. So this is going to be a $3,593 unfavorable variance. I will mention in the next chapter, when we take a look at expenses in more detail, we'll start to unlock the reasons for these favorable and unfavorable variance. Does it have to do with using more of that particular input, or does it have to do with using a more costly input? So let's go ahead and start to finish off our flexible budget performance report. Our column all the way here to the right is going to be our planning budget. We're going to use the exact same formulas that we use for a flexible budget, but this time instead of using the actual activity level 128, we're going to use our plan or static budget number of jobs of 120, what we thought we were going to use originally. Again, using our same formulas here, we're going to populate this. For example, revenue was $275 per job. Now times 120 jobs is $33,000. If I take a look at technician wages, because it's fixed, it's going to stay at $8,400 because we didn't anticipate it was going to change. On the other hand, those mobile lab operating expenses, $4,600 fixed component plus the $30 variable cost per unit times 120 jobs is $8,200. Again, add up all our total expenses, $24,860. Compare it to our planning or static revenue of $33,000, and we get a planned net operating income of $8,140 when we were originally planning on just selling 120 jobs. So let's go ahead and do our variance. Well, what's the variance called when we compare our flexible budget to our planning budget? It's called an activity variance. Why is it called that? Because we're using the exact same formulas, and the only thing that's different between these two, flexible and planning budget, is the activity level. Actual for flexible budget versus plan for the planning budget. So let's go ahead and start to work through this. Flexible budget revenue, 35,200, is greater than what we planned, 33,000. That's a good thing when we have more revenue than we originally planned, so it's going to be a $2,200 favorable variance. Let's start to go down here through our various expenses. Technician wages, because it's fixed and we don't have any difference, 8,400 and 8,400, there's no activity variance. We don't anticipate a fixed cost is going to change. On the other hand, mobile lab operating expenses, the flexible budget was 8,440, while the plan was 8,200. That's a $240 difference. Because our flexed expense is greater than what we planned, it's going to be unfavorable. I'll start to work through here. You notice my other expenses that have a variable portion are all listed as unfavorable. And you'll notice my fixed expenses are all listed as none. Again, flexible and plan, we're using the same formulas. A fixed expense, if that's all it has, isn't going to be anticipated to change. But on the other hand, if I have a variable component, we would expect a change to happen. And the reality is, because we're basing this flexible budget based upon a greater number of jobs in this scenario, we would anticipate all the expenses to be unfavorable. Because again, it's based upon a greater number of jobs, so we got to expect that our expense likely would be unfavorable and greater than we anticipated. Compare our total expense, flexible budget expense of 25,132. That's greater than our planning or static budget of 24,860. $272 difference, and again, it's going to be unfavorable. And again, I'd expect my fixed to have no activity variance, and since actual activity is greater than plan, I'd expect my other expenses that have a variable component to be unfavorable. If we had flipped this around and said that the actual number of jobs was less than, then all our expenses would have had a favorable activity variance. So we would have gone the other direction. Let's look at net operating income for the flexible budget, 10,068, compared to the planning or static budget of 8,140. This net operating income should be a good thing, and we anticipate that it's going to be greater than the planning or static budget, so we get a $1,928 favorable variance. So let run through all our different calculations for the flexible budget performance report.